second part of this video series of the Lent term revision material. So now we're going to start looking at the kind of financial market section, so weeks 3 to 5. And we're going to start with week 3, where we look at exchange rates and capital flows. So the emphasis here is thinking about how international trade and finance can affect the macroeconomy. And in particular, we're going to consider a couple key questions. So the first question that we're going to think about is, how are exchange rates determined? And we're going to come at this from two different directions. So first, we're going to think about it in terms of how the trade flows of goods and services are going to pin down the exchange rate. And to do this, we're going to think about, in particular, the real exchange rate. So we're going to start off just with this accounting identity or definition of the real exchange rate. So note that this is something that always holds in the data by definition, because the real exchange rate isn't something we directly observe in the data, but it's something we calculate in this specific way. So that's just an accounting identity or a definition. There's nothing very deep about that. What turns us into a theory of exchange rate determination, or rather nominal exchange rate determination, is if we apply this PPP condition. So suppose the law of one price holds for all goods, and then if we extend that to the kind of average price level in the economy, so uppercase P, if all goods cost the same when expressed in a common unit of currency. So this is the average price of the domestic basket of goods expressed in terms of the foreign currency. And if that is equal to how much that same basket of goods is going to cost in the foreign country, in foreign currency, then we get this condition here, which is another way of saying that the real exchange rate is equal to 1. So if that's true, then we now have a way of pinning down the nominal exchange rate. And in particular, if we rearrange this, what we see is that the nominal exchange rate is going to be equal to the ratio of the foreign price level to the domestic price level. Or if we take this in terms of growth rates, this tells us that the growth rate of the nominal exchange rate is going to be equal to foreign inflation minus domestic inflation. So if domestic inflation is higher than if foreign inflation is higher than domestic inflation, then our nominal exchange rate is appreciating. Okay, so that's one way of thinking about exchange rates, which is basically coming from a no arbitrage condition, but applied to goods and services. Another way of thinking about exchange rate determination is thinking about no arbitrage conditions in financial markets. And in particular, we're going to think about the carry trade, which basically tells us that the return in domestic currency from investing in a domestic bond should be equal to the return, again in domestic currency, which is why we have this expression here, from investing in a foreign bond. So as before, so when we're talking about the yield curve, we're assuming risk neutrality of investors. So they're happy to equalize expected returns. And if we take logs and differentiate, we do the usual thing. Actually, you don't even need to differentiate. So if you just take logs and use the rule that, for example, the log of 1 plus IT is going to be approximately equal to IT. And if you apply that to that equation, that uncovered interest parity condition, you get the same equation in terms of the expected exchange rate appreciation. So this is going to give us a theory of nominal exchange rate determination in terms of, rather than the foreign price level and the domestic price level, or foreign inflation, domestic inflation, foreign nominal interest rates and domestic nominal interest rates. So here, there's a couple reasons why this is nice. One key one is that it now gives us a very clear way of linking monetary policy, where we thought about monetary policy primarily in terms of nominal interest rates, to policy or exchange rate policy. And that leads us to the concept of the trilemma, which we can see very nicely from this first equation. So there's a number of reasons why you might think, you know what, it would be really nice to manage my nominal exchange rate. Why? Because suppose I do a lot of trade with the US, or there's a lot of investment flows between my country, let's say my country is Panama and the foreign country is the US. I want to peg my local currency to the US dollar to ensure that it's stable, which will reduce the risks of cross-border trade and cross-border investment flows, stimulating trade, stimulating investment, which is going to grow the economy. So I want to fix my nominal exchange rate. The trilemma tells us about the costs, or what I have to give up in terms of policy choices if I wish to do that. So from this equation, we can see that we can only choose two of the three following things: free capital flows, independent monetary policy, and a fixed exchange rate. How do we see that? Well, first remember that if we have free capital flows, that's precisely what causes this equation to hold. The fact that if returns are higher in one country than another, after adjusting for exchange rates, capital can freely move to the country with the higher returns, pushing up its nominal exchange rate and pushing down the exchange rate where the money is flowing out of, balances this equation. So free capital flows is captured by the fact that we have inequality there. So given that we have free capital flows, and that this equation therefore has to hold, it then shows us that we can only choose one of two things. So either we choose to have independent monetary policy, i.e. we set IT, in which case the nominal exchange rate has to simply adjust. So if this goes up, that has to go up, and vice versa. Or if instead we want to fix our exchange rate, that means that the nominal interest rate and therefore monetary policy has to be a kind of a slave to our exchange rate policy. So there's no more independence with monetary policy. If we would like to both have independent monetary policy and a fixed exchange rate, what do we have to do? We have to break this equality. How do we do it? We stop free capital flows, and we have capital controls. So that's why we can only have two out of the three policy options that we might like. So that's a discussion of what determines exchange rates, and also if we look at this uncovered interest parity condition, it also links to a theory of what determines capital flows between countries. The next question you might ask is, okay, so we've spoken about what causes capital flow to flow between countries, but what happens once capital flows into a country? What does that country do with it? And this brings us on to the question of misallocation, which is going to be a very important discussion, particularly for thinking about what happened with the Eurozone debt crisis between periphery and core. So this is a kind of a classical model of what happens in a perfect market when you have capital inflows and nothing goes wrong. So this green line here represents a production possibilities frontier for whatever economy we're considering. So let's say it's Spain. So clearly it shows that there's a trade-off between producing output in the non-tradable sector. So this could be like construction, and the tradable sector, which you could think of as manufacturing. Okay, so how do we move from less tradable output to more, so if we want more, let me say that again. Suppose you wanted more tradable output. So suppose you're at point A and we wanted more tradable output. What would we have to do? We would have to allocate more resources to the manufacturing sector. Where would we get those resources from? Well, we get them from the construction sector, so we'd have to reduce non-tradable output. So that's why this green curve is a production possibilities frontier. And when we move along the curve, we're essentially reallocating resources between these two sectors. What happens when we have a capital inflow? So this production possibilities frontier is shifting out. Why is it shifting out? Well, when you have a capital inflow, you essentially have more resources in the aggregate, which means, for example, you could think of this as a parallel rightward shift. You could have the same amount of manufacturing, allocate the new capital to the construction sector and have more construction, right? Or you could have the same amount of construction, more manufacturing, or you could have more of both. So that's what happens when we have a capital inflow. And then the last thing to remember is that these blue curves are, you can think of them about like indifference curves for society as a whole. And they're basically telling you, given your preferences of manufacturing output versus construction output, what's the optimal allocation of resources given your resource constraints before the capital inflows. So point A would have been optimal, and then your resource constraints after capital inflows, so point D would have been optimal. So this is a good scenario. This is when everything goes well and capital inflows are clearly going to be welfare enhancing for the economy. Okay, so what happened in reality in the Eurozone? So this dotted line represents this kind of ideal PPF after the capital inflows, when everything went well. And now we're going to think about relative to that benchmark, what actually happened. And there's two issues. So the first issue is that there was misallocation between sectors. What does that mean? Well, here we're showing that with a pivot down of this green dotted line to this red line. Why? Well, the basic idea is that the non-tradable or construction sector was favored relative to the tradable sector. So you can think about it being the non-tradable sector was subsidized and the tradable sector was taxed in some sense, which meant that when you shifted one unit of output, when you shifted resources from the non-tradable to the tradable sector, i.e. when you reduced one unit of output in the non-tradable sector, you got less of an increase in output in the tradable sector. Okay, so the relative returns of investing resources in non-tradable to tradable was distorted. So this caused the slope to flatten, and also the PPF moved in. So aside from the slope getting flatter, you can also see that you've lost all of these production possibilities. And the way you want to think about that is just that this kind of process of artificially subsidizing the non-tradable sector and taxing the tradable sector is essentially this kind of inefficient political meddling in the market, which creates a lot of rent-seeking behavior and a lot of inefficiency. So not only are you distorting the trade-off between investing resources in non-tradable versus tradable, but you're also just losing resources as a society. Okay, so that's the between sector misallocation. And then you also have this within sector misallocation. So what are we showing here? Well, now after the capital inflow and the between sector misallocation, we're ending up on that dotted red line. The within sector misallocation is going to cause us to move to this concave final PPF for the economy. So what's happening here? Well, we're saying that after the between sector misallocation is accounted for, if you only had resources in the tradable sector, you wouldn't lose anything because of within sector misallocation. So clearly this within sector misallocation isn't affecting the tradable sector. It's only affecting the non-tradable sector. So what does it say? It says when you put some resources into non-tradable output, the output that you get from the non-tradable sector is now lower than it would have been otherwise before the within sector misallocation in the non-tradable sector. So point number one is from this diagram is only in N. Point number two is less output in N, all else equal. And then point number three is as you try and produce more in the N sector, this loss of output due to this within sector misallocation is getting bigger. So problem increasing in size of M. Okay, so that's how you want to interpret this diagram. So in reality, so even though we've drawn the misallocation within the sector as only being within the non-tradable sector, if you look at data from Spain, for example, there was clearly misallocation across many sectors, but here we just, to illustrate the principle, thinking about what happens when there's only misallocation in the end sector, where it seems like this misallocation may have been relatively worse in terms of the within sector misallocation. Okay, so a key thing to take away from all of this, now that we've understood how to link this diagram with this concept of misallocation within and between sectors, is going to be to think about what effect is this going to have on two things. One, productivity, and on a related note, resource allocation. So the key point is that if we were supposed to end up at point D in terms of what happened after the capital inflows when there was no misallocation, we might end up, for example, at a point, let me call it E here, which is clearly worse than D in terms of, you have less of everything. And it's also a point where the size of the non-tradable sector is very large relative to the tradable sector. Okay. So that covers week 3. In week 4, we start thinking about banks and the financial system, and we're going to think about 3 key questions. So the first is going to be how banks add value for society, because this question isn't immediately obvious. The second question is what is going to make banks special. And the third question is how should policymakers respond to the answers to these first 2 questions. So all of these questions flow on from one another. In terms of answering the first question, we're going to think about 2 key models that represent how a banking sector can add value to society. The first model we're going to look at is the Diamond-Dybvig model. And here the answer to the question is going to be that banks add value by providing this maturity transformation service for people. So what does that mean? Well, banks, by creating these balance sheets in which they have short-term liabilities, i.e. demand deposits, but long-term assets, so long-term investment projects, they're essentially going to provide a type of an insurance contract for their customers or for potential investors. So the idea is going to be that if you're someone with money and you would like to invest that money, you could invest it directly in a project, but that project might not be able to give you a return immediately for whatever reason. So instead, you and many other people in your situation can take your money, give it to a bank. The bank can then go and invest some or all of that money in a range of different long-term projects. And because the bank has the so-called law of large numbers on its side, it's going to be able to have money liquid and available for those people who might end up needing it at very short notice, while also still having a lot of money invested in long-term projects that are going to give kind of relatively high returns to the people who are able to be patient and wait for the, that kind of project to finish its natural course. And in essence, what the bank is doing in the Diamond-Dybvig model is it's really providing insurance contract for investors who ex ante don't know if they're going to be an early type or a late type. So what the bank can do is they can provide a deposit contract which gives a relatively high payment to the early types who have some kind of liquidity need very early on, unexpectedly. And it's able to do that by cross-subsidizing their returns from the returns of the late types who are going to wait for their investments to mature. And ex ante, that's going to make everyone better off. So banks are doing this great thing in this model. However, things can also go wrong. And in particular, one key insight from the Diamond-Dybvig model is that there's going to be multiple equilibrium. So I just described the good equilibrium, where all this maturity transformation happens, everything runs smoothly, and banks improve people's welfare. However, you can also have this bad equilibrium, this outcome in which you have a bank run, which is going to turn out to be a very dangerous thing because it's going to be a self-fulfilling prophecy. So if I believe that everyone else is going to run to the bank, it's only going to be rational for me to run to the bank, because otherwise there's going to be no money left for me in the bank. If similarly everyone else believes that everyone else is going to run to the bank, then each of those people should also run to the bank. So given these beliefs that can emerge for no good reason, it is actually rational for everyone to run to the bank, and those beliefs will be justified by the fact that they see there is a bank run. So what's going to happen is we're going to have the situation where you have a bank run. This causes the maturity transformation of the bank to break down. So the bank can't play this useful role, and it could even turn into a very bad situation where, because of all this chaos and kind of financial instability, it actually really reduces people's welfare. And this is going to be a danger of these banks. So while they can do something good, they can also lead to a very bad outcome. So then the immediate policy question is, how can we kind of have the best of both worlds? So how can we have the benefits of maturity transformation without the risks? And one very important insight has been that of deposit insurance. So if the government provides credible deposit insurance to all depositors, then no matter what rumors start circulating about the health of the banking system, you know that no matter what, your money is safe, which completely removes your incentive to run to the bank. Similarly, it removes everyone else's incentive to run to the bank. And the beauty of this policy is that if it's perfectly credible and if it works as it's intended, the government never actually has to provide this deposit insurance. So it becomes a so-called off-equilibrium threat or promise in this case. So this is fantastic. You have banks, they're doing all the good stuff. You've eliminated the possibility of the bad stuff, and you've done it with a policy that ultimately ends up costing you nothing. So we're going to complicate this nice picture slightly. Obviously, in reality, there's a lot of complexity that we've ignored. But a key additional layer that we introduced later in the week 4 material is the concept of monitoring. So in order to do this, we're going to introduce a second banking model, the Diamond-Raja model. And now what's going to happen is, instead of thinking about banks as adding value by engaging in this maturity transformation and providing liquidity insurance to their customers, banks are now going to add value by providing monitoring services. So the idea is that because the banks specialize in monitoring, they're kind of better at monitoring. And if depositors or people who would potentially be investing directly in projects are able to channel their money through banks, then they're able to tap into this kind of higher level monitoring expertise that banks have. And this is going to essentially make them more comfortable investing larger amounts of money into projects, facilitating the flow of credit in the economy. That's the basic story. Here, however, the banker, just like you, so the whole reason the banker is adding value here is because you need to monitor the entrepreneur. But similarly, depositors also need to monitor the banker, right? So the banker can also misbehave in this model. And bank runs in this model are, or rather the possibility of bank runs in this model, is actually going to be a good thing. So in the Diamond-Dybvig model, it's strictly a bad thing. Here, the possibility of the bank run is going to be a good thing because it's going to be what disciplines the banker, which kind of forces him to use his monitoring expertise in the interests of his depositors and therefore ensure a good flow of credit and thereby maintain a good equilibrium outcome. So if we take our conclusion from the Diamond-Dybvig model, which told us that deposit insurance is fantastic because it eliminates the possibility of the bad bank run equilibrium, here we're going to have the reverse situation where deposit insurance is actually going to be bad because it's going to remove the threat that depositors have, which is essentially disciplining the banker. And by removing that threat, that can lead to bad behavior by the banker and therefore bad outcomes. So the conclusion now is that yes, deposit insurance is good for the reasons we already discussed, but it also needs to be associated with other regulations to ensure that even in the absence of a bank run, the banker still behaves well. Okay, and then the last week in this section on financial markets is about modern financial crises. So the week 4 material that we we're just discussing is, you can think about it as being a more traditional view on how financial institutions work, and how crises can emerge. This week 5 material is a more modern take on how financial institutions work and how crises can emerge. And in particular, the focus is going to be on the euro area crisis. So there are going to be 4 key concepts that we're going to review from this material. So the first one is going to think about how modern banks are different from traditional banks and how the structure of the financial system has changed. And that's going to be related to representing these changes in terms of these best response curves and how banks respond to those best response curves. And this is going to give us one set of tools so these first 2 points are going to give us one set of tools for thinking about how you can have very quick capital inflows, but then also very quick and destructive crashes. Okay, and then a second kind of framework for thinking about financial crises, in particular in the euro area, is thinking about this distinction between solvency and liquidity in markets with financial frictions. This is going to be very useful, for example, for thinking about sovereign debt crises. And then finally, we're going to think about the diabolic loop, which is going to incorporate a bunch of stuff that we've already touched upon in the previous 3 broad areas. Okay, so starting off with just how is a modern bank different from a traditional bank? So this was discussed quite extensively in the relevant problem set, so I won't go through it too much here. But remember, the key idea is that the balance sheet of a modern bank looks very different from a traditional bank. So modern banks have taken, on the asset side, a lot of their loans to individual customers. So for example, these would be loans made to people buying houses, which we call mortgages. And it's repackaged these loans and bundled them up through securitization and turned them into asset-backed securities. So for example, mortgage-backed securities, which we call traded assets. So that's why the modern bank has relatively few loans in terms of standalone financial assets, but a lot more tradable assets because it's just repackaged these loans. So that's the difference on the asset side. In terms of the liability side, these tradable assets can then be used as collateral to obtain wholesale funding, which means simply to borrow money, and typically large quantities of money, from other financial institutions, hence the name wholesale. So a traditional bank depended primarily on lots of small deposits from individual customers to finance its asset purchases. A modern bank instead still has deposits, but also has a whole lot of wholesale funding, often in the form of repurchase borrowing arrangements from other banks. And remember that this wholesale funding, so there's a few key characteristics, but 2 very important ones. One is that it is collateralized, depending on those tradable assets. And 2 is that it was very short term, so in many cases overnight. And this allowed these banks to grow very fast, but also meant that the lenders could pull money out very quickly. So you could have a very quick boom and a quick bust as well. Okay, so how can we think about this change in the balance sheet structure of these modern banks in terms of how it might affect financial market outcomes? So this shows you the best response curves of, say, Bank A relative to kind of the other banks in the economy. And it tells you how much that Bank A should lend as a function of the average lending of all the other banks in the economy. And to make this kind of diagram a bit simpler, it's implicitly assumed that all the banks in the economy are the same, so their best response curves. So we're showing you Bank A's best response curve, but in the background you have the other bank's best response curve, and that's just going to be a mirror image flipped around the 45-degree line because these banks are assumed to be identical. So what does this tell us? It tells us that when other banks in the economy lend more, Bank A, in terms of its optimal action, should lend less. Why? Well, when we have a traditional bank, what's going to happen? If the other banks in the economy lend more, if we assume that basic idea of a diminishing marginal product of capital. Well, as they invest more, they take the good projects. There's only bad projects or low NPK projects left. So my bank A has less incentive to make loans to these less good projects, so I lend less. So that's why we have a downward sloping best response curve. What does this idea with the shock tell us? Well, suppose there's some shock to the economy. The current coronavirus could be an example. So something happens which says, for a given amount that other banks are lending, my bank A suddenly wants to lend less. Okay, so there's a shock to my willingness to lend. When you have these downward sloping best response curves, what you should see is that when I get hit by the shock, and similarly all the other banks in the economy get hit by the shock, if we just responded to the shock and we didn't take into account each other's behavior or response to that shock, we would end up at this point, let me call it point G, right there. Okay. And what do we see? That the ultimate equilibrium outcome is not point G, but point H. Why? Because we have these downward sloping best response curves, our actions are attenuated, or we attenuate each other's actions. So because I've now cut in response to the shock, and because the other banks have also cut in response to the shock, then we both in turn want to increase our lending a little bit. So we attenuate each other's actions, and the final impact of the shock on lending is less than the impact purely from the shock itself. So the shock gets attenuated, which is a good thing. It's leading to stability in the financial system. However, with a modern bank, you have these upward sloping best response curves, which tell us that when other banks lend more, my bank also wants to lend more. Why is that the case? Well, remember that we have this balance sheet structure on the right-hand side. So what happens when other banks lend more? Well, that pushes up. So for example, if other banks issue more mortgages, that pushes up demand for housing in the economy, which pushes up house prices, which makes the mortgage-backed securities that I have more valuable. So this pushes up the value of my traded assets. I now have more collateral, which means I can obtain more funding from other banks. I can go to them with that more valuable collateral and say, hey, please lend me more money. They lend me more money, which means I can make more loans. But then I can immediately securitize these loans, so then I have more tradable assets. And we kind of have this cycle where if other banks have lent more, that increases my ability to lend more. So that's why we have this upward sloping best response curve. And the key thing here is that, unlike the previous case, so that's how much I would cut my lending in response to the coronavirus shock, taking as given the actions of the other banks. This horizontal arrow is how much the other banks would cut their lending in response to the shock, taking as given my actions, i.e. my actions before the cut. So purely based on the cuts from the shock, we would end up at point G. What we see, however, is that this shock gets amplified. So we don't end up at G, we actually end up at point L. Because once I've cut and the other banks have cut, we both want to cut even more. So that shock is getting amplified. And in addition, we now have the possibility, or in this case, we do have multiple equilibria that emerge. So before there was always one unique equilibrium, before and after the shock. Now we have multiple equilibria. So in addition to the shock being amplified and us moving to point L, we could also jump all the way to this new bad equilibrium, i.e. engage in this multiplicity jump, and that could cause a huge decrease in credit. So overall, what you should notice here is that because these best response curves have become upward sloping, this can make the banking system extremely sensitive to relatively small shocks. So we have the initial shock, the impact gets amplified by the upward sloping nature of the best response curve, and if we have multiple equilibria, we could even have a multiplicity jump. Okay, so that then moves us on to this discussion of solvency and liquidity. So let's think about this in the context of a country. Let's say the example of Spain, which we already discussed. So Spain needs to borrow some amount Q. So Spain goes to, let's just neaten that up. So Spain goes to financial markets and says, I would like to borrow Q equal to, I don't know, let's say here it's 1/8. Okay, so think about it as 1/8 of a billion if you want. If that makes it easier, 1/8 of a trillion. So Spain would like to borrow that money from international financial markets. And when they go and they ask that money, then the lenders are going to quote them some amount that they have to promise to repay. So that amount that they quote is going to be F, this thing here. So Q is on the horizontal axis, F is on the vertical axis. So what F are they going to get quoted? Well, the assumption here is that if investors or lenders provide the Spanish government with Q, they would like to get back an equal amount in expectation. And so the key thing to know is what Spain has promised to pay back in terms of F is not necessarily what they'll pay back on average, because there's going to be this possibility of default now. So investors or lenders know this, so they are going to ask Spain to promise some amount F, which ensures that on average what they get repaid is equal to what they gave Spain. And we make various assumptions in order to understand what relationship this implies about how F should vary with Q. So there's two different sets of assumptions you make. The one is without frictions. So we think about a world in which if Spain does not have enough money to pay back the F it promised to pay back in full, it just pays back whatever it can. That's the world without financial frictions. Then there's a world with financial frictions in which if Spain doesn't have the money to pay back in full what it owes, then it pays back nothing. And also in particular, whatever money it does have to pay back, that value is completely destroyed. So it's not like Spain keeps the money, that value just kind of disappears. So under those two sets of assumptions, and under certain assumptions about the distribution of Spain's cash flow Z, so in particular we assume that Spain's cash flow is distributed uniformly between 0 and 1, then we get this green parabola curve, this with frictions curve, and this red upward sloping line without frictions, showing us the relationship between how much Spain wants to borrow and how much Spain has to promise to repay. So I'm not going to go carefully into the derivations of these curves, but basically if you follow the maths, what you will see is if you look at this diagram on the left hand side, so the expected repayment without financial frictions will just be the area of the triangle and the rectangle determined by whatever F is being promised to repay. So if Spain promises to repay F low, then the expected repayment will be the area of the triangle and the rectangle. That is the without frictions case. In the with frictions case, Spain's expected repayment, when it promises to repay F low, is just going to be the area of the rectangle. So the area of the triangle is now the loss of value on average from defaulting in a world with financial frictions. And that area, you can think about it as being captured by the gap between the with frictions line and the without frictions line. Okay. So a couple important insights from this diagram. So first one is that if we're in a world with financial frictions, and I would say this is probably the most important one, then we can have multiple equilibria. So for a given amount that Spain wishes to borrow, so here we've called it Q prime, Spain could be quoted that it has to promise to repay either F low or F high. Investors are indifferent between these two scenarios because their expected repayment in either case is the same. They just get back Q prime in the expectation. But for Spain and for society collectively, F low is much better than F high. Why? Because in the case of F low, because Spain has to promise to pay back a relatively low amount, it's often able to pay it back. So in all of these cases here, its cash flow is high enough to pay back and avoid default. Therefore, default is relatively rare, and therefore the costs of default are relatively low in expectation. If, however, Spain is forced by its lenders to promise to repay F high, then this is a very bad situation for Spain and for society collectively, because there's very few situations in which Spain's cash flow is enough to repay back the loan. There's many cases in which Spain is defaulting, and all of this value is going to be lost, represented by that horizontal distance there. So clearly from a social perspective, F low is the good outcome and F high is the bad outcome. In terms of lenders, however, they're indifferent between the two, so either equilibrium could emerge, depending on what lenders believe about the creditworthiness of Spain. So a liquidity crisis is a situation in which Spain is initially at this good equilibrium. Everything is fine, and then for whatever reason, lenders become very pessimistic about Spain's ability to repay. It gets pushed into a bad equilibrium. The amount that it has to promise to repay for a given amount of borrowing goes up, which is the same as saying it has to promise a very high interest rate on that borrowing. This makes it very likely that Spain defaults, and we know that default is socially costly. So that's a liquidity crisis, which is purely the result of bad expectations on the part of investors or lenders rather than bad fundamentals. And then you can have a solvency crisis, which is quite different, which is a situation in which Spain's fundamental ability to repay is actually going down. So you could think about that as maybe their borrowing needs are going up and going up and going up. So how much Q they need is going up, even though their ability to repay isn't going up. So we can see that's going to, even if they're at F low, that's going to keep pushing up the amount they have to promise to repay, pushing up the interest rates. And at some point, they're going to need to borrow so much, they're actually going to be in default, or they're going to be unable to raise that money. And that's going to be a solvency crisis. So in terms of reality, we don't really get to see these graphs. All we get to see is the amount that lenders ask Spain to repay in terms of interest. And when we see interest rates spike, like we did in the Euro crisis, it could either be because we have a liquidity crisis in which Spain is actually still solvent, but is just being kind of forced into a corner by financial markets, which is pushing up their interest rates on their debt. Or it could be that it's actually got a solvency crisis and it's trying to borrow too much relative to its ability to repay. It's very difficult for us to know which is which. In the case of the liquidity crisis, there's a very strong role for the IMF to play in terms of preventing that. In the case of the solvency crisis, it's not really clear that the IMF should be stepping in. Okay, and then to wrap up this week 5 discussion about modern financial crises, we're just going to talk about the diabolic loop, which is going to draw upon what we've already discussed. The basic idea is that suppose there's an initial trigger where the government's default risk goes up. If we're in a world in which domestic banks hold a lot of government debt as their own assets, so these domestic banks have a lot of government bonds, when the government default risk goes up, this reduces the value of these government bonds, reducing the value of these banks' assets, which then basically leads to two different scenarios. So one scenario is, or I should say two different channels. So one channel is that when banks' assets lose value, that's basically going to mean that the bank is more likely to go bust and therefore more likely to need a bailout from the government. But since the bailout from the government requires government revenues, that puts further pressure on government finances, further increasing the government's risk of defaulting, further putting downward pressure on the value of those government bonds. So that's one loop there. So that's the outside loop. In terms of the inside loop, the other issue is that when banks' assets lose value, as we discussed in the problem set, this undermines their ability to make loans to their own customers, some of whom are firms in the economy. That reduces real activity in the economy, reducing tax revenues, putting further pressure on government finances, and further increasing sovereign default risk. So that's its second inside loop. Both these channels are going to lead to a feedback effect in which the more damaged the government's finances, or the more at risk the government is of defaulting, the more at risk the banks are, and the worse the bank's balance sheets are. And this loop can go on and can become very powerful. Okay, so that concludes week 5. In the next video, we'll discuss weeks 6, 7, and 8, where we look at business cycles and stabilization.